go from micro to macro. We have Ankita Pathak, who's a macro strategist and speaks about global equities as well. She's a fund advisor at Ionic Asset, joining us this afternoon. Welcome, Ankita. I want to first start off by understanding how you're seeing the global setup at this point. You have US, which has hiked tariffs on China further by 200, or rather now making it 245% a tariff on China. With this entire battle playing out, how does India stack up, and what is your strategy globally with regard to where you're deploying?
Hi, good afternoon. It's a pleasure to be here firstly, and I think a bang on question. I think at this point it really doesn't matter whether it's it's 200%, 300% of tariffs, because this news is going way farther than what we would have imagined. So I think there are three possibilities here. One is that this is a US China war. Everyone else is just looking at it from a viewership perspective, and within US China also, they are smart enough to not have it on commodities that matter, right? So you saw US exempt smartphones, semiconductors, etc., which was, I think, a it's a smart move because US big tech needs this. Then the second case is that this war actually escalates, and that is when the other countries need to start putting retaliatory tariffs, because someone needs to, nobody wants to bear the brunt of it. So there's excess supply in the market that China will now hold. Where will it go to? Will it go to Europe? Will it go to India? Will it go to Latin? And therefore, will these countries have cross tariffs happening? In my opinion, this is the worst probability that could happen, which will lead to a lot more volatility, I would say, in quarters ahead and not just months. And then the third outcome, which is, I think, the best case possibility, is that, China and US sit on a table, they get this out of the way. Maybe you'll have headline numbers which are obnoxious, but for commodities that matter to the rest of the world globally, those will be out of the tariff zone, and basically the trade will continue as is. So this could be the war more of words than of substance. So if I were to go probability wise, I think the first outcome that I mentioned, that this is a US versus China war. Everyone else is now holding their seats just to see how this unfolds. I think that is where we are, where the 70% probability is. I would still say there's a 10% chance on this escalating. And I think 20%, the best case scenario, is where the two countries also solved for themselves. Now, within this, how we are investing globally has become very, very, I would say, interesting for us also. So from a very top-down perspective, I think Europe as an economy in itself is coming out strong. We've seen, flows move from US to Europe. We've seen Europe also do a lot more fiscal stimulus, revive of the defense expenditure. And it's also coming from very, very low valuations equity-wise. So I think that has come out as a great space to be, which is not subjected to as much volatility as US and China right now is. So that is one space that we are watching. Of course, we also are not fully dismissive of the US and China market also, because within these markets, there exist businesses that don't depend on each other economy for supply chains, revenues, and because the major indices are getting, thrashed, and you see these whiplash movements in the indices, it is indeed a great time for an active manager to find opportunities which are fundamentally good businesses. And now I think in next 3 to 6 months, these businesses which were historically trading at about, I would say 30 times forward PE would fall under 17 times forward PE and would become attractive again for the next cycle.
Ankita, would you taking large allocation calls right now, considering the situation is fluid and maybe talking about valuations or prices might be less material currently, or are you taking those bets right now?
No, so we're taking very, very cautious calls. We are holding large amount of cash.
Okay.
there is obviously fundamentals, there is good businesses, but there is also a lot of uncertainty. And I mean, let me just bring this example up when, Trump said that smartphones, etc., are exempted. And then yesterday he said, all your big tech companies did really well for a bit. And then yesterday he said that, one kind of a chip is the H20 chip, which NVIDIA could send it to China before. They can't do it anymore. And then you saw that volatility kick in, and all of these tech names were also slashed. So this has nothing to do with fundamentals. This has nothing to do with, valuations, etc. But I think for us, we are holding cash and we're looking for opportunities where this impact is the least and could be the least. The best way to do this is that when you're doing US companies, don't do companies which have a very strong supply chain from China or revenue from China. Similarly, when you're doing China, don't do companies which are very heavily dependent on global exports. And I think that way an active manager can protect the fund from tariff wars.
So Ankita, therefore, how should, so you're positive Europe is what I understand. You're also positive silver within the commodities basket. Are you increasing allocation even at this point to silver over gold? You prefer gold as the better commodity, silver as the better commodity? Give us the rationale.
Fantastic. So gold and silver both have been our very, very strong call at Ionic Asset. At some point, we also wanted to, tell people that 2025 is going to be the year of asset allocation. So we need to look beyond equity and maybe carve out incremental allocation to both gold and silver. So we started with saying, more gold, less silver, and this would be, about a year back from now. From there, of course, gold's returns are known to all of us, and I think at this point, it is silver which remains like a very strong buy on dip commodity for us. Also easily accessible to Indian investors now. Silver because it is very undervalued compared to gold. So I'm sure gold to silver ratio at 90 times is at a historic high. The industries that silver catered to, especially in EVs, renewables, etc., are seeing a good demand. And if we do not see a worldwide global recession, the chances of which are very, very meager because Fed has its own tools to exercise, I think silver remains a very strategic buy on dip. And I would definitely prefer it over gold. Coming to gold, I think for investors who bought gold, we are still recommending hold and not a clear sell because I think there is still some value on the table. And this is coming from increasing and continued increase in demand. So the data has not really changed. And second, from the fact that when there is global uncertainty like this, if the risk of sentiment lingers on for another 6 months or so, I think gold will continue on the margin to do well. So between gold and silver, I would say more silver, less gold, but not a hard call on gold to sell as of now. I think there is still margin there.
Point taken. And what about the US 10-year? There's been just so much volatility there. Would you at this point, and also given the fact that there'll be roughly $10 trillion of repayments that the US will have to make or refinancing which US will have to do in calendar year 2025, would you at all look to bet on that, or do you believe that at some point you will get better pricing even there?
Sure. So I think US 10 years have become, I mean, it's a question in itself. It has broken the long known correlation with the dollar index also. So yields are high, DXY is under 100. It's an interesting macro picture to have. But let me just break down the US 10 year into what's happening structurally versus what's happening tactically. Structurally, of course, there has been a fall from domestic buyers. There has been a fall from foreign institutional buyers. And of course, we know the US's big debt problem. So the supply has been very high. So the sheer fact that demand is falling, supply is high, would lead to higher yields. That is now beyond this, there are also many movers of US yields today. Okay, so one, there was a huge supply that was expected this week itself, and it looks like investors have really sold their existing holdings ahead of the fresh supply. Again, there is something known as basis rate, which was used by the hedge fund managers, where the difference between the treasuries and the future could be used to make money. And the expectation is that there is a huge unwinding of this basis rate that is also happening, which is pulling up the US yield. So I think these two are very, very current factors. These are transient factors versus demand supply, which is a very, very structural factor. So I personally believe that the transient factors is something that is causing this unprecedented volatility in the US yields. We are seeing a movement of about 20 to 30 basis a day, which is unprecedented and unusual. In terms of, what would be a good point to buy a US 10-year, I think it's a good staggering point. So I personally, if the yields are, hovering above 4.3% onwards, I think some exposure can be taken for US treasuries for investors who do so. And then over time, once Fed has to act, maybe it's 6 months from now, when these yields start to fall, there will be a directional play towards I would say 3.5, if not lesser on the US yields.
Thank you for that perspective, Ankita. Thanks for taking out time, coming in, speaking with us.